Hello, world. This is John Pinto, your roving realtor, bon vivant, video blogger, podcaster, home chef, raconteur. And I am here with John Dudek from Sage Settlements to talk about structured installment sales, especially as they pertain to overcoming post COVID-19 challenges for residential real estate investors. How's that for a mouthful, John Dudek?
Yeah, that's quite an intro. Thank you for that. I think talking about this, we've done a few of these, John, me and you, and talked kind of offline as well about how this can help primary residents. This structured installment sale that we've been discussing, SIS for short, and it does work well for primary residents. But I think investors also have a really compelling case with it. Uh, One main reason is they don't get the same exclusion from the IRS on their capital gains that primary residents do. So now you're kind of looking at a larger amount that you're going to be paying on that property if it's appreciated in value.
Yes, that is a motivation to not selling for cash and paying the 37% taxes you might be facing on selling your income property, but doing a structured installment sale and spreading it out over a period of years and getting under the tax thresholds. That said, let's address the pain point for these investors. You know why you don't want to ask a tenant landlord how they're feeling? A tenant landlord attorney, how they're feeling.
Why is that?
Well, because then they'll send you a retainer bill for $25,000. If you're lucky, maybe 15,000. But in order to just get a tenant landlord attorney to sit down and talk with you, you're probably looking at $15 to $25,000 to start an action to evict an uncooperative, non-paying tenant. It's pretty dire.
Yeah, it doesn't surprise me. I mean, I imagine their phone's ringing off the hook, given the kind of the environment of the tenant landlord relationship that's allowed to go on in our great state. And, maybe it's like that throughout the country. You probably know better than me, but I know it's trying to evict a evict a tenant. It can be a dicey proposition to say the least.
Right. Well, I won't do a deep dive into social commentary, but California, bless California, it's a nanny state. They want to take care of everybody, and you could understand that. And they didn't want mass evictions under COVID-19 when we had all these shutdowns. Could you imagine what mass evictions would have done with the epidemic, with homeless people running amok, which is still an issue? So in their judgment, they passed all these eviction moratoria, and all other impediments for the landlords, big and small. I mean, if you have a small landlord with a mortgage on a house, a duplex, a triplex, or a fourplex, and they've got non-paying tenants, the tax assessor still wants to get paid their property taxes. The insurance company still has to get paid because it's a condition of the loan to have insurance in place. And you certainly have to make the loan payments, or otherwise you're going to get foreclosed upon. So it's a little bit of a one-way street in terms of having eviction moratorium and not requiring tenants to pay rent, and still requiring the landlord to make all the other payments that they need to make: principal, interest, taxes, insurance, maintenance, utilities, what have you. So the landlords wind up in a very untenable situation. And, if you go into your favorite search engine, whether it's Google, mine is Bing Copilot, and you say, what does it take in California to evict a non-paying tenant? It's enough to scare a buzzard off a dead horse.
I I don't doubt it whatsoever. I'm sure you see it more than I do, but yeah, I mean, just if you just listen to the news or see the headlines pop up on your phone of things that have happened, there was some story about people taking over squatters taking over a house in Beverly Hills. I don't know if you heard about that one.
Yeah,
Where
yeah. Yeah.
The whole neighborhood finally had enough, but there was nothing they could do, even in that area.
Right, right. So let's get into the details on the structured installment sales. Of course, we're going to assume for purposes of this video on California residential real estate investors, let's opine that these investors started with a couple of single family dwellings back in the 60s, the 70s, or the 80s, kept doing 1031 exchanges and trading them up to duplexes, triplexes, fourplexes, wound up with multiple units. So their basis in these properties is very low when you add in what they've paid, what their depreciation recapture is, and the improvements they made on the property. The properties have gone up in value. The basis is very low. The incremental difference is subject to probably a 37% federal state tax bracket along with the Medicare tax. So enlighten our investors on how they could sell for cash if they don't want to continue to do more 1031 exchanges and want to extricate themselves from this unfavorable tenant landlord environment that we have in California.
Sure. Yeah. So they've had enough. They've had enough of the tenants. They've had enough of improvements and things like that. So what you can do, if you're looking to sell, if you're looking to cash out, is instead of taking all of your proceeds in year one and paying that, excuse me, paying that large lump sum in capital gains tax, is you can take your sales price, invest it into an annuity. It's called a structured annuity with an A+ rated carrier like MetLife, where you're going to earn a rate of return on pre-tax dollars and take that money over time instead of in one lump sum, whether you take it over 2 years, 4 years, 8 years, 20 years, whatever you decide, spread that out. And instead of paying that lump sum of capital gains tax, you only pay a prorated amount in each taxable year that you receive the money. So essentially, you're splitting it up over however many years that you want to do the investment, which, depending on your other income and your other situation, can really get you in some more favorable tax brackets than you would if you took it all in the first year.
So let's get specific with the investors because the investors are going to want to know what the most tax advantage way of approaching this would be. So I think you mentioned that the sweet spot for married couples is 250,000 in income, and for single individuals, it's 200,000 in income, which would be the amount of proceeds you would take in each and every installment, including the year of the sale, correct?
That's right. Yeah, that the reason we talk about that threshold, that's the Medicare tax that you mentioned. It's also called the net investment tax, was put into effect during the Obama administration, I believe, but it's 3.8% on the sale of an asset. And if you're a single taxpayer, anything over 200,000, subject to an additional 3.8%. And if you're married filing jointly, it's 250,000. So if we can keep your installment payments below those amounts, that initially wipes out almost 4% of taxes. And concurrently, being in that range also is going to drop you from the highest federal tax rate, which is 20%, down to the 15% range. So that's another about 5% savings. And then the tax, or excuse me, the state of California taxes, it drops you from about 13.3% to in the 8 or 9.3% range. So quite a bit of, three different levels of getting you into lower brackets, and that's going to add up over time.
So let me just underscore that if they were going to sell for cash, they'd probably be looking at paying 37% federal, state, and Medicare taxes on their taxable gain. But if it goes into the structured installment sale, Number one, their proceeds would be just about 100% of their equity into the annuity, and the annuity would be amortized over the entire amount, not over the 37% reduction. And they would take those installments at increments under 200 if they were single, under 250 if they're married, minus any other Social Security and retirement income that they have, so that the total income is under 250 for married couples, 200 for single individuals. Is that correct?
That's the goal. Exactly. Yeah, is to try and get you under that threshold, but also make sure that you're generating the type of income you need. You know, if this is depending on your situation, you may have some immediate needs. So we want to certainly work with your financial advisors, with your CPAs, and talk to you about your specific situation, the investor situation, to meet each unique goal there. But that's the idea is let's pay less taxes, let's spread it out over time, let's turn that investment property, which essentially is there to generate steady income, right? I mean, that's what rents are, is just getting steady income from your tenants. Let's turn that into steady income from an A+ rated life insurance carrier and get rid of all the headaches that go along with owning that investment property.
Right. Now, let me advise our listeners out there, California residential real estate investors. John is a structured installment sale consultant. I am a real estate broker. We are not tax attorneys. We are not CPAs. And not only do you want to talk to your CPAs and your tax attorneys about this, of which we will definitely invite them into the conversation, but you also want to double check how your depreciation is going to be recaptured, because that's above our pay grade. Because if they've been doing multiple exchanges over decades, they're going to have quite a bit of depreciation to recapture.
Yeah, and this is a topic again that I know enough to speak briefly on, but if they've done any sort of cost segregation on it, I know that also is recaptured in a way, and it's recaptured at a higher rate than normal capital gains. So yeah, all that needs to be talked about with your CPAs.
Right. Okay, very good. So just summarizing this episode, California residential real estate investors have been taking a beating over the last 3 years um, over landlord-tenant laws, eviction moratoria, rent control, et cetera, et cetera, et cetera. It's been very, very difficult. And if you do, and there's all kinds of registration requirements now with the local municipalities. So if you are reaching a point where there's just too much duress being a California residential landlord, this is a good way of converting all of that frozen, highly taxable equity, highly appreciated taxable equity into a tax advantaged income stream where you could give yourself a little bit of a break and go from tenants and toilets to passive tax advantaged cash flow. Your final comments on the subject, John?
I think as always, you said it pretty well. You know, this is something that not only people that are sick, maybe sick of being landlords, having issues with their tenants, but investors that are maybe getting up there in age, don't have heirs that they want to leave these properties to, that they want to use these properties to finally cash out and improve their quality of life. There's a lot of different ways that this could be effective for California investors. So we're happy to talk to you and looking forward to going over your unique situations and showing you some options that maybe you didn't know existed out there in the real estate world.
Very good, very good. Well, I want to thank all of you for viewing our video, and please like, subscribe, get notifications, share, watch our videos. And this is part of a continuing series on structured installment sales. So feel free to fast forward or rewind and watch prior episodes and subsequent episodes. And thank you for watching, and we'll see you on the next video. Bye for now.